Hey guys, come on in. Hey guys, hope all is well. I had a little time to record some videos here for you. I know we get a lot of questions, which a lot of them can be answered with our Cocktails with Kurt if you check out our YouTube page. But I wanted to actually do kind of a 6-day, take it step by step of the process, the six, I like to call them the tenets that you need to qualify for a mortgage, purchase a home, but more importantly, stay in the home. And, so many times people are rushing to get, homes, and there's a lot of lenders and agents out there that will sell you this dream. But what we try to do here differently at Great Homes ATL is when we say it, we mean it. You become family. And we were not able to become homeowners ourselves the first time we wanted to as a couple. And I know there's a lot of couples and even single people out there that had experienced what we did. So I kind of want to just break down in very easy, simple terms for you of the 6 things that you will need. And one of these 6, if you don't have one of these 6, can prevent you from either getting the home or staying in the home. So, listen up closely. I'm recording these for you. And the 6 tenets are income, number 1, debt, number 2, credit, number 3, number 4 being down payment, and number 5 being closing costs, and number 6 being a reserve fund. So let's jump right into it in this first video and talk about income. Now, income for, I don't know the ratios, but myself, I worked in corporate America up to 2014. Kurt still works in corporate America, and the majority of you are going to work for a company that pays bi-weekly, weekly, probably not monthly, it's usually weekly or bi-weekly. And those are salaried employees, could be also hourly employees. And in general, it's people that have a job with a corporation. They got their health insurance paid through them, minus deductibles, of course. You maybe have a 401k to contribute to, things like that. So at the end of the year, typically by January, was it 30th or 31st, you'll get a W-2 in the mail, which will tell you based on your salary, based on if you're an hourly employee that also did overtime, how much you made for that year. And that's what a mortgage company is going to utilize to say, this is how much you make a year, and it's verifiable. And there's probably less risk for them because you have a job and it's deemed, pretty steady and all that kind of stuff. You're also going to get what are called pay stubs, right? Whether that's weekly or bi-weekly or bi-monthly or whatever the case may be, bi-weekly. And you're going to be able to pull that off of, your HR website or go to your HR department and provide proof of those pay stubs. The other type of income is what I am doing now. And there's also a large segment of the population. If you're an entrepreneur, a business owner, we're LLC ourselves. And we're also independent contractors, or at least I am. Kurt is being a real estate agent, me as a real estate agent and a broker. So whether you drive Lyft or Uber, you have your own nail salon, hair salon, some kind of business owner, you're a consultant, you have your own restaurant, whatever the case may be, you're going to be called what's called a 1099 worker. And a 1099 worker, again, typically does not have health insurance or has to pay it out if you're a business owner. And you're going to be looked at kind of like with a profit and loss statement. So for instance, if you're a straight out 1099 or W-2 worker that gets paid $48,000 a year, is pretty straightforward, right? That's your gross salary. 1099, say you're a business owner or an independent contractor and you drive Uber or Lyft, or you're a real estate agent, or you're an insurance broker, whatever the case may be, and you're a 1099 worker. So you made $100,000 that year in 2017, let's just say. And you wrote off, because of your expenses, travel, car, a home office, cellular bill, cellular mobile bills, maybe, health insurance that you had to pay for, whatever the case may be, and you had $50,000 worth of write-offs. Well, they're going to look at you in that tax year when you file your taxes as $100,000 of revenue minus your write-offs. So they're going to show that you made $50,000. Even though you made $100,000, they're going to look after what your write-offs are that you made $50,000. In 2018 now, second year, you maybe had even a better year. You made $150,000. And again, you had about that $50,000 for write-offs. So you made $100,000 that second year. They're going to need 2 years because you're at higher risk. You're self-employed, right? You're an independent contractor. They're going to average those 2 years and they're going to say you made $75,000 for those 2 year periods. And that's what they're going to qualify you off of. So where people come and have some issues is maybe they were a W-2 worker and then they quit their job or they got laid off or they decided to tap into that entrepreneur spirit, and 6 months, even a year and a couple of months, they're doing pretty good, and they're going to now try to qualify for that mortgage. It's going to be harder for that 1099 because you need 2 full years of tax returns. Because when you're a W-2, you could just pay, provide your pay stubs. It's steady income every 2 weeks. It will show even if you got bonuses and stuff like that on your W-2. So it's a much streamlined process. You don't need necessarily those 2 years, but a 1099, you definitely are. So keep that in mind. There's a lot of times with 1099 workers where they get into trouble where they're like, hey, I made $150,000. You might have, but when you're recording it for tax purposes in your write-offs, that's where the trouble is going to come in because you're saving in taxes, which is a good thing. But when it comes to a mortgage, they're going to look at what you basically netted compared to a W-2 worker, where they're going to look what you have is gross income. And then finally, is income is, the same type of thing. If you maybe have been saving for your down payment and you're a W-2 worker, and you've been working for Lyft or Uber, or you've been doing waiter or waitressing on the side, or hosting duties or consulting on the side, as long as you have 2 years of that, you can combine your W-2 with your 1099. So if you made an extra $10,000 over the last 2 years, or averaged about $10,000, and you had a $50,000 salary, you could count that extra $10,000, so they'll qualify you off that $60,000. And then your other sources of income are for this other bucket of pensions, Social Security disability, military vet, anything like that. That's going to be looked at more like that W-2 because that's going to be government, giving you a check every month. So that's more traceable, and if anything, it's probably not going to go down, it's going to go up. So those are the 3 buckets of income. That's just one facet. So when people ask us all the time, what income do I need to qualify for this $300,000 house, $150,000 house? We really can't tell you because you're going to need these other 5 tenets of debt, credit, closing costs, down payment, and reserve funds. So let's get into the second topic of down payment, or let's get actually into the topic of debt and how that can influence you in ratios and all that kind of stuff. So remember, guys, income, tangible income coming in, W-2, pay stubs, 1099 if you're an independent contractor or business owner, and the third bucket if it's your government income from Social Security, a pension maybe, disability, Social Security disability, or a veteran that's getting that pension from the government. All right, guys, stay tuned for bucket number 2, debt. We'll talk to you soon.